Let's be honest, I wasn't exactly born with a stock ticker in my hand. My early years were filled with the usual childhood dreams and ambitions, none of which involved the stock market or financial planning. In fact, for years, the word investing sounded as foreign and intimidating as trying to speak Klingon. It was a concept that seemed reserved for the elite, the financially savvy, and those who had some sort of secret knowledge. It seemed like something only Wall Street hotshots in fancy suits did, not regular folks like me. The idea of navigating the stock market felt like trying to decode an ancient script. I was content with my savings account, blissfully ignorant of the potential my money held. I thought I was being responsible, putting away a little bit each month, watching the balance grow ever so slowly. Then came my wake-up call. A friend casually mentioned their investment portfolio, and suddenly my comfortable world of savings accounts felt awfully small. It was like a light bulb went off in my head. I realized that while I was playing it safe, others were making their money work for them. They were taking calculated risks and reaping the rewards. It dawned on me that my money was just sitting there, not really growing, certainly not working for me. The interest from my savings account was barely enough to keep up with inflation. I needed a change, but where to begin? The world of investing seemed vast and complicated, filled with jargon and concepts that were completely foreign to me. The thought of deciphering complex financial jargon and spending hours researching stocks filled me with dread. I didn't have the time or the energy to become a financial expert. There had to be an easier way. I couldn't be the only one feeling overwhelmed by the prospect of investing. Thankfully, there was. My friend introduced me to the world of index funds, and it was like a breath of fresh air. It was simple, straightforward, and didn't require a deep understanding of the stock market. My friend explained that index funds were a way to invest in a broad range of stocks, spreading out the risk and making it easier for beginners like me to get started. Finally, a way to invest that didn't require an MBA in finance. I could start small, learn as I went, and gradually build my confidence and my portfolio. It was the lazy approach I'd been dreaming of, and it turned out to be a game changer. I began to see my money grow in ways I never thought possible, all without the stress and confusion I had feared. Imagine trying to pick out the fastest growing trees in an entire forest. Daunting, right? That's what trying to pick individual stocks can feel like. Index funds, however, are like investing in the entire forest. They hold a basket of stocks representing a particular market segment, like the S&P 500, which tracks the performance of 500 large U.S. companies. The beauty of index funds lies in their simplicity. Instead of agonizing over individual stock picks, you're essentially investing in the overall growth of the market. They're like the set it and forget it option of the investment world, requiring minimal effort and expertise on your part. Plus, their low fees mean more of your returns stay in your pocket. It was the perfect solution for a newbie investor like myself. So, how do you actually put this lazy investing into action? Let's break it down step by step. It's simpler than you might think. The key is to make the process as effortless as possible. First, choose a reputable brokerage firm that offers low-cost index funds. These firms often provide a range of investment options that are perfect for the lazy investor. Many even have user-friendly apps that make investing accessible from your smartphone. This means you can manage your investments from anywhere, at any time. Next, decide on your investment goals. What are you aiming to achieve with your investments? Are you saving for retirement, a down payment on a house, or your child's education? Clearly defining your goals will give you a roadmap to follow. This will help determine your time horizon and risk tolerance. Knowing how much risk you can handle and how long you plan to invest will guide your choices. Once you have a plan, automate your contributions. Automation is the lazy investor's best friend. Set up regular transfers from your checking account to your investment account, just like paying a bill. This ensures you stay on track without having to think about it. This pay-yourself-first mentality ensures consistent investing, even when life gets busy. It's a simple way to build wealth over time. Don't worry about timing the market or trying to pick the perfect moment. The market will have its ups and downs, but staying invested is key. Remember, we're aiming for steady, long-term growth, not get-rich-quick schemes. Patience and consistency are your allies in this journey. The magic of compound interest. Your money's snowball effect. Now, let's talk about the real star of the show, compound interest. This financial phenomenon can transform your savings and investments in ways you might not have imagined. It's often called the eighth wonder of the world, and for a good reason. The power of compound interest lies in its ability to generate earnings on both your initial investment and the accumulated returns from previous periods. Compound interest is like a snowball effect for your money. Just as a snowball grows larger as it rolls down a hill, your money can grow exponentially over time. As your investments earn returns, those returns are reinvested, generating even more earnings over time. This cycle of earning and reinvesting can lead to substantial growth. The longer you stay invested, the more powerful this compounding effect becomes. Time is a crucial factor in maximizing the benefits of compound interest. Think of it this way. If you invest $100 and earn a 10% return, you'll have $110 at the end of the year. This might not seem like much at first, but it sets the stage for future growth. The next year, you're earning 10% on $110 and so on. Each year, your investment base grows, leading to increasingly larger returns. Over time, even small contributions can grow into significant sums thanks to the magic of compounding. Regularly adding to your investments can accelerate this growth. This is why starting early and staying invested for the long haul is crucial. The earlier you begin, the more time your money has to grow, and the greater the potential for substantial financial rewards in the future. Investing education at your fingertips. Gone are the days of relying solely on expensive financial advisors. Today, a wealth of information is available at your fingertips. Social media platforms like YouTube and Instagram are brimming with personal finance influencers who break down complex concepts into bite-sized, easy-to-understand pieces. Look for creators who prioritize education and transparency over hype and get-rich-quick schemes. Numerous websites and apps offer free educational resources, articles, and even interactive tools to help you on your investing journey. Don't be afraid to dive in and educate yourself. Remember, knowledge is power, and the more you understand about investing, the more confident you'll feel managing your money. Consistency is key. Slow and steady wins the race. In the world of investing, consistency trumps everything else. It's not about trying to time the market perfectly or pick the next hot stock. It's about consistently investing over time, rain or shine, market ups or downs. Remember the story of the tortoise and the hare? Slow and steady wins the race, and the same applies to investing. Don't get discouraged by market fluctuations or feel pressured to make drastic changes to your portfolio based on short-term trends. Remember your long-term goals and trust in the power of compound interest to work its magic over time. The key is to stay the course and ride out the inevitable market bumps along the way. Start small, dream big. You don't need a fortune to start investing. In fact, you can begin with as little as a few dollars. Many brokerage firms allow fractional shares, meaning you can buy a portion of a share even if you can't afford the full price. The important thing is to start somewhere and develop the habit of regular investing. Remember, investing is a journey, not a destination. It's about taking control of your financial future and building wealth over the long term. So, embrace the lazy approach, start small, stay consistent, and watch your money grow. You might be surprised at what you can achieve.